From Bloomberg World Headquarters in New York to our TV and radio audiences worldwide, welcome to Balance of Power, where the world of politics meets the world of business. I'm David Weston. Big news right now is down in Washington with President Trump once again, where he says he is very seriously considering a capital gains tax cut, a move he decided against last September after saying it wouldn't do enough to help the middle class. For more, we welcome now Bloomberg tax reporter Laura Davison. So, Laura, I've heard about this capital gains tax cut before. It's coming back again. Why is it coming back now?
Well, Trump has really tapped into his presidential authority now that Congress has really hit an impasse on all of the coronavirus stimulus talks. And we saw the series of executive orders over the weekend, including one on payroll taxes. And he's been talking with his advisors, and they've been coming up with some other things he could do, this capital gains tax cut being one of them. So he can't do everything. Like, he has limited power here. He can't actually cut the capital gains rate. But what he can do is kind of create this workaround so investors won't pay tax on the appreciation that is inflation, essentially. So they just look at how much your asset appreciated, subtract out the inflation, and you only pay tax on what remains. Yeah,
exactly. I mean, you'll pay capital gains tax, but it'll be inflation adjusted, essentially. The president says that's going to create a lot of jobs. How does that work? Why would it?
Economists dispute that point and say this doesn't really do much for economic growth, and it really incentivizes old investment, not new investment. So in terms of the jobs or when economists model this out and look at, points to GDP, it's, maybe a tenth of a point, over the long run.
And how does Congress feel about this? I mean, as you say, typically Congress gets to decide about taxes or not. Is there support for this kind of move, at least by Republicans up on the Hill?
There's some Republicans who have supported this. Senator Ted Cruz has been pushing the Trump administration to do this for several months now. I'm kind of seeing that this isn't politically viable in Congress. This is pretty much a non-starter with Democrats. You look at Joe Biden's tax plan, it would basically double the capital gains tax rate. So Democrats and Republicans are very far apart on this issue.
Why is the president saying he's seriously considering it? Why doesn't he just do it? If he has the power to do this indexing, not just absolutely taking it back, but indexing, why doesn't he just do it?
Well, it's not 100% clear that he can do it. This has been looked at before. George H.W. Bush actually seriously looked into this back in the late 80s. His advisors told him that he didn't have the power to do it, so he dropped the idea. President Trump picked it up, and he has some people telling him he can, but there's also some people, Treasury Secretary Steven Mnuchin included, who aren't a big fan of it.
Okay, thank you so much to Bloomberg's Laura Davison reporting from Washington. Now we want to take a look at this capital gains tax cut from the point of view of President Trump. And we bring in now a senior economic advisor to Trump 2020. He's Steve Cortes. Steve, thank you so much for joining us. So give us the playbook from President Trump's point of view. Why is this a sensible move?
Well, David, first, let me just thank you for having me. It's been a long time since I've been on Bloomberg TV, and in my former life on Wall Street, I would come on and talk about stocks and earnings. Now I come on and talk about politics and policies. But to get to your question here regarding indexing of capital gains, I do think it makes a lot of economic sense. In other words, that investors should not be punished. They should not have to pay taxes on gains that resulted just flowing from inflation. Now, we haven't had a whole lot of inflation, thankfully, in decades in this country, but nonetheless, I do think that makes sense to me. It's not my call. Clearly, it will be up to the president, and there's a lot of disagreement among both economists and lawyers about whether or not he can do it on his own. But let me just say this more foundationally. I am 100% in favor of tax reduction, of tax relief for Americans. I've yet to meet a tax reduction that I didn't like. And I think this is important for this economic rebound in our country. What the president did over the weekend, regardless of what he decides to do or not do with capital gains, what he already did over the weekend in terms of suspending the payroll tax, that is an instant pay raise to millions of Americans, working class folks who make less than six figures, who are going to very quickly see a jump in their take-home pay to give them the confidence to continue to spend and to believe in this economic rebound, this economic rebirth of America from the corona crisis.
Steve, why are you confident that, in fact, employers will actually give that money back to the employees? Because this is a deferral. This is not stopping the payroll tax. It's just saying it's put off. And a lot of people are concerned, employers and employees, there's going to be a big tax bill come due in January.
That is possible. Now, the president has clearly stated that it is his intention and his goal to make it permanent. But even if it's just a deferral, I still think that is immediate aid to Americans in need, because a lot of working people, even people who did not lose their job, who are still actively working, they are understandably concerned. This country was walloped by an economic meteor. It's nobody's fault. It's not President Trump's. It's not the Democrats' fault. It's certainly not the fault of American workers. I think the only group of people we can blame are the Chinese Communist Party for their deception. They infected the world knowingly, and they crashed the global economy. What we can do from here, though, is we can instill confidence in people. We can put money in their pockets. We can, for those who are still looking for work, I think this is also critical. For those still looking for work, we're offering extended, enhanced employment benefits. For people who have student loans that are going to be difficult to manage right now, they now have the relief of knowing they don't have to pay them for the rest of the year. So I think what the president is smartly doing here, he broke the legislative logjam because Nancy Pelosi and her cronies were trying to play politics with the pandemic, and he said, I'm going to deliver immediate aid, immediate relief to those still looking for work, and immediate pay raises to those who are working.
So, Steve, you've been talking about putting some money in the pockets of workers, and that's either the payroll tax deferral or, for that matter, the unemployment insurance. Let's come back to the capital gains tax cut, because that's not putting money into the pockets of workers. And how does it work exactly? President Trump saying that's going to create lots more jobs. Explain that to me, particularly when we are near the zero bound on interest rates. The cost of capital for companies is approaching zero right now. Is that really what's keeping people from investing?
Look, it can be part of it. And I'm not saying that that's a silver bullet that would solve everything. And of course, the president hasn't made any definitive decision yet regarding capital gains. So I certainly don't want to get in front of him or in front of the White House. But I would say this. While our primary aim is wages and is American workers, we know, of course, that investment is often required to spur those wages on and to spur the confidence in employment. And what is good for investors can be very good for wage earners. Capital gains in this country, in my view, should be indexed to inflation. It doesn't make sense to tax somebody if there's a gain, if a portion of their gain is only due to the natural rate of inflation in the economy.
Well, okay, that's sort of a fairness argument. I think I understand that argument. Fair point. But when it comes to the economy and getting the economy going, which is what we all want to do right now, is this the best way to do it? Because it's a practical matter. Am I going to invest in plant and equipment if I don't think the demand's going to be there? Isn't the problem from the economy right now, Steve, the demand side, not the supply side?
Oh, listen, and I would certainly agree with you. I think it is primarily on the demand side. I mean, I think we can do both, right? I don't think it has to be binary and either or situation. But I agree with you. It's primarily about getting consumers, getting workers confident again. That's why I think this payroll tax cut was so critical, and I hope it does become permanent. The president has said has stated clearly his intention that it will become permanent. I also think, though, there are other policies. It's not only about taxes. There are other ways to instill confidence among consumers and American workers. For example, smarter trade deals, which has been critical. A critical component of the Trump boom was getting tough, finally, confronting China and the Chinese Communist Party and its abuses of American workers, encouraging onshoring back to this country, but also then proving that America first doesn't mean America alone economically, negotiating with our partners, our neighbors and allies, Canada and Mexico, the USMCA. So smart trade deals, both those already completed and those in the works to come. That is also another example of policy prescriptions that can instill confidence in consumers and can deliver enhanced, better wages to American workers.
Steve, as I say, you're a senior economic advisor now to Trump 2020, the campaign for President Trump to get reelected. As I recall, last go-around in 2016, he had questions about cutting capital gains. He actually said it tied Hillary Clinton to Wall Street. Is this a shift for President Trump? Does this sort of associate him with, forgive the expression, the fat cats rather than his classic base?
No, listen, I think it's clear that President Trump's priority is American workers. It is the workers of Dayton, Ohio, rather than the investors of Davos. I think that is clear. It was clear in 2016. It still is today. What I would say, though, is that we are in an incredibly unusual economic situation. You know, again, this crisis, which is not of our own doing, it's the fault of the CCP. This crisis, which has been a global crisis, but in terms of America's ability to confront this crisis, necessitates that we think in policy ways that we would not have thought about perhaps even just as recently as a year ago. So again, the primary objective is to help workers and to enhance wages, clearly. However, is a capital gains shift part of doing that? It might be. And again, the president has made no decision on these issues.
What can you do? What can the president do, I should say, Steve, to really get the economy headed back in the right direction by November 3rd? That's a critical date. and things like capital gains tax cuts, that's going to take some time, I think. What could be done right now beyond those 4 executive orders to get the economy headed in the right direction before Election Day?
Right. Well, David, first I would say we are headed in the right direction. So that's critical. Let's realize, and I'm not making light of the challenges that are still ahead. And I know we have a lot of work to do to reclaim the heights of the Trump boom that we enjoyed as recently as the early part of this year. But the green shoots do abound, and I think it's important that we recognize that. And it's not just the job market, as critical as that is. There are also other metrics that affirm the massive gain in jobs that we've seen over the last 3 months. For example, home sales in the month of June, the most recent month reported for existing sales, was the largest on record. Manufacturing index, ISM, which we got last week, was the highest in a year and a half. So there are reasons for optimism and reasons for hope. What I would also say is this, and I think this is something media is not talking much about.
Right.
When we look at the virus trends in the United States, when you look at hospitalizations and deaths, this second surge, or if you believe it's the end of the first surge, however you want to classify it, those numbers are rolling over, meaning rolling over in our favor toward fewer hospitalizations, fewer deaths. I think that will instill confidence in the people in the coming weeks and months into the election.
We can certainly hope. Thank you so much. Really appreciate you being here. That's Steve Cortes. He's Trump 2020 Senior Advisor for Strategy. Coming up here, we talk with the once and maybe future Republican Congressman from California, Darrell Issa, about what Washington needs to do for the economy. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. It's time now for Bloomberg First Word News. For that, we go to Mark Crumpton.
David, thank you. U.S. health officials are expressing skepticism about Russia's claim to have a coronavirus vaccine. Health and Human Services Secretary Alex Azar tells ABC it's more important to have a safe and effective vaccine than to be the first to produce one. The Russian vaccine was registered before phase 3 trials. Those trials normally last for months and involve thousands of people. New Zealand is taking quick action against its first COVID-19 cases in more than 3 months. The Prime Minister, Jacinda Ardern, is locking down her country's largest city, Auckland, for 3 days to prevent another outbreak. New Zealand has gone 102 days without a new case of coronavirus. Ardern says the nation has beaten the virus before and can do so again. The U.S. Secretary of State Mike Pompeo is in the Czech Republic. He's kicking off a 4-nation tour of Central and Eastern Europe, expected to focus on threats to the region posed by Russia and China. The tour is seeking greater roles throughout the continent in the energy, infrastructure, and telecommunications sectors, a trend the United States would like to reverse. We don't know yet who Democratic the presumptive nominee Joe Biden will choose as his running mate, but that person has a staff of campaign aides ready to get to work. The Biden campaign has hired a team, including longtime Biden insiders, veterans of the Obama White House, as well as some newcomers. Bloomberg has learned Biden has interviewed all the top VP candidates and could make an announcement this week. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David?
Thank you so much, Mark. Well, this isn't the first time we've seen Republicans and Democrats square off over major policy actions, but the stalemate over stimulus comes at a particularly challenging time for the American people and for the American economy. Welcome now Darrell Issa, who served for 18 years as Republican congressman from Southern California and is now running to go back to Washington to represent California's 50th congressional district. Congressman, thank you so much for being with us. Give us your sense, because you're a businessman, successful businessman. You've spent a lot of time in Washington, about where we are right now with the economy as we head into an election.
Well, first of all, what you're seeing in Washington is that people can argue about what they agree on. We agree we want to put money into the workers' hands. We want to make sure that that we're stimulating the economy. And so whether it's the president's executive action that's being proposed or the stimulus where they argued over $600 versus $400, Congress has let us down again. But what you're seeing today, and what I think is noteworthy, is the market is pricing in success in 3 areas. They're pricing in success in the vaccine. They believe that this Manhattan-level project is going to lead to a vaccine in a reasonable period of time. They're pricing in an economy that's still stumbling. It still has a lot of workers out, but that's going the right direction. They believe it will. And quite frankly, they're pricing in President Trump's successful reelection because they're pricing in a continuation of policies that are going to ensure that we keep going in the right direction economically.
So that's a great analysis. Is it possible, as it sometimes happens, the market is overpricing? And particularly, let's talk about vaccine, because I talked to Dr. Fauci last week, and he pointed out there's something in between a fully effective vaccine that we get by the end of the year that's 100% effective and something less than that we may have to deal with this disease for quite some time to come chronically. Is that something the market is pricing in, that we may have to have some social distancing for a good long time?
Well, they're certainly pricing in the fact that this could end up like the flu, which runs between 15 and 60% effective each year. We never actually beat the flu. We simply reduce it using these vaccines that are constantly chasing a slightly different flu every year. So first of all, I think that's the case. They're pricing in the fact that the mortality rate, if you had no fix for this, is about 2.5 per thousand, and much less in younger people. And they're clearly pricing in, for example, these reductions in harm, such as the British use of steroids, that have given us a 75% reduction in the number of people that have to go on the ventilators, and obviously a reduction in the number of people who die. So yes, I think they're pricing in a balance of an imperfect vaccine, but a significant reduction in the distraction that is occurring to the economic activities of our world.
Congressman, I wonder how you rate the reactions of the various states to this disease in this respect. As we look around the world, there tends to be a correlation between some countries, South Korea, some European countries, some other countries, who really shut down a lot and their economy is doing better than we did. Have we underreacted to this disease?
Well, we've reacted in two different ways. Initially, we said it was about not overwhelming our healthcare system. Then it got switched to some sort of hypothetical, we're going to beat this by staying at home. The problem is you can't have 25, 30, 40% of your workforce, quote, essential workers, going to work and coming back to their families in the ordinary course and then think you're going to beat it. So this in between has been a problem, but it's a problem that Dr. Fauci and others created by sending us two different messages, only one of which you can actually do. We could and have kept our emergency rooms from becoming overcrowded and thus people unnecessarily dying. We haven't done what, for example, New Zealand did, or Taiwan, which was cracked down to where they actually stemmed the virus completely by having a zero tolerance. We weren't willing to do it. We've never asked the American people to do it. And now the expectation that it'll happen is unrealistic. So I do think we have to look at it differently. Remember, we've been a little bit more like Sweden, who made the decision that they were going to live with the virus, look for some herd immunity, and keep their economy going. And as a result, our economy didn't shut down as many as some, but of course, we also shut down more than others.
One regard in which we were really different from a lot of other countries, and Dr. Fauci and other public health experts would say we should have done, and that is basically a national testing policy. Everyone seems to agree we haven't done what we need to do in testing. Should we now have a national policy on testing?
Well, I'm not a medical doctor, and Dr. Fauci's been wrong a lot. But I would say in this case, if you look at the testing for antibodies, looking for people who've recovered, we're certainly not doing enough of that to have people who could return to the workforce safely in large numbers. There's a lot of people who don't know. They're sitting at home in quarantine when, in fact, they could be back to work successfully and without spreading the virus. So, yes, we should do more of that. But let's remember, we as a nation did something that we should all be proud of. Because of our ability to keep electricity and telecommunications to almost the entire United States, we've been able to telework in a way that has allowed our productivity not to shrink nearly the way others did. When you look at Google and other tech companies and why their stocks are up because they've shown that they won't be overly adversely affected by this kind of a shutdown, quite frankly, as long as they have electricity.
Okay, it's always a pleasure to have you with us. That is Darrell Issa. He's former Republican congressman from California. As I say, he's running once again. Still ahead, later in the program, we're going to talk with former House Minority Leader Eric Cantor, now vice chair of Moelis. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. It's time now for the stock of the hour, but today actually it's sector of the hour. We're going to talk about tech. Scarlett Fu is here. So Scarlett, once again, the markets are up, although tech is lagging. I'm not used to that. What's going on?
Yeah, we're not used to that at all. You're right. The recent laggards are getting bid up on a hope that a vaccine will be here soon and an assumption that Washington will get its act together and come up with some kind of relief bill. The cyclicals, really, and we're talking about groups that are super sensitive to the economy, industrials, small caps, autos, capital goods, they are all doing better. It's like April and May all over again. I look at the S&P 500's best performers, and you've got names like Wynn Resorts, Expedia, Norwegian Cruise Line, Gap. You know, the Dow has now outperformed the NASDAQ 100 in 5 of the last 6 trading days. And yesterday, it was by the most in a month. So clearly, this is a shift away from big tech, which was a defensive posturing because of tech's strong balance sheet, steady earnings growth, and natural advantage in a work-from-home world. Now, when you look at things on a technical basis, David, big tech is certainly extended. Almost a quarter of the NASDAQ 100 trades above its long-term trend line, the 200-day moving average, and more than a third of the New York FANG index are above the 200-day moving average as well.
So Scarlett, among other things I don't quite understand is we normally say when it comes to stock prices, we look at earnings, and we were all looking forward to the earnings season. Big tech did pretty well in the earnings season, so why didn't they get rewarded?
They did get rewarded, and that's the thing. Nick Colas of DataTrack points out that when it comes down to it, the element of surprise is what moves a stock price. And the second quarter earnings, as you point out, showed that tech did very well. The sector was surprisingly resilient. But the group's ability to continue to surprise is probably pretty limited from here on out. And when you do look at the valuations, it's clear it's stretched. Dave Wilson points out that the FANG companies and Apple and Microsoft have a price-to-sales ratio of 8.3, a new high. It's come down a little bit since then, but that's what it got to. The S&P 500, by contrast, trades at 2.5 times sales, the Dow at 2.2 times sales, and the Russell 2000 just above 1 time sales. Negative real yields, of course, helping to justify all those valuations, but that may have reached a turning point because real yields are a little bit less negative than before. Ben Emmons of Medley Global Advisors, David, calls this a careful rotation. He says for a major rebalancing to happen, you need to see a vaccine take place, a vaccine come through.
Yeah, exactly. And what have you done for me lately? Once again, the stock market. Okay, thanks so much to Scarlett Fu. Coming up next, we're going to talk with Stephanie Kelly of Aberdeen Standard Investments about those miserable UK jobs numbers and the state of the European economy. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Jobs numbers out of Great Britain this morning showed the biggest drop in employment since 2009. But nonetheless, we're a bit better than expected, with unemployment at 3.9% rather than the 4.2% that had been estimated. We welcome now Stephanie Kelly, Aberdeen Standard Investments senior political economist. So Stephanie, always a pleasure to have you with us. Give us your sense on the British economy right now and how it's doing.
Well, I think particularly what the jobs report is showing is, clearly there's been some demand destruction through the COVID crisis, as you might expect. Naturally, particularly we're seeing older workers and younger workers and those in low-skill jobs most affected. I think that really matters for those longer-term issues around income inequality and the kind of longer-term structural challenges across developed markets. But it's kind of one of those things where you look at numbers and you say, gosh, that looks rough. But then think about the furlough scheme that's in place here in the UK, whereby, there's a lot of job protection. They're looking to remove that in the autumn. And so the numbers could look a lot worse once that furlough scheme is removed. And, employers genuinely have to decide whether to keep people on or whether to lay people off.
We haven't talked about it recently, but what about Brexit? Doesn't that kick in supposedly at the end of the year? Might that affect the economy as well? Or is that fully priced in at this point?
I mean, I think everyone's kind of enjoyed a break from the Brexit never-ending uncertainty, but the reality is it's still there and it's still in the background. I think one of the concerns I often have is that, there's wide expectation that they'll get to a narrow trade deal, but for investors, we really need to think about what does that mean? A narrow trade deal, it does mean, potentially tariff-free access to European markets, which is crucial for a lot of UK firms. But it does also mean things like, trade barriers get put in place in terms of customs checks. So if you're a producer and you rely on super efficient supply chains, they might be in trouble, as well as huge uncertainty about the regulatory environment. And so I think investors have been distracted a little bit by what's going on with COVID. I think the complexity is going to depend on the company level, but it's the kind of work we need to be doing as investors to understand, even in a world where you get a deal, that there will be challenges for the UK economy and for UK businesses in 2021.
Stephanie, move across to the European continent, if you would. How's the economy doing there? It seems to be doing better, right?
So I think with the European economy, what we've seen is quite significant bounce back, particularly in, we had quite strong industrial production data out of a number of European countries a couple of weeks back. And so it's clear that as you reopen the economy, what we're seeing is a significant bounce in demand. And that's not just European, right? We're seeing that across a number of economies. But the harder work is yet to come because we've got this push-pull between the virus and the economy being open. And so increasingly, you're likely to see these localized lockdowns, and that's going to have a marginal impact on behavior. And then they reopen. And that push-pull, I expect that cycle to continue, throughout the end of 2020 and even through 2021, vaccine dependent.
So as you look at it, is it a matter of how well various governments are handling the coronavirus, or is it all that stimulus, both monetary and fiscal? We had that, 750 billion euro fiscal infusion coming up at least?
So I think that there's a real kind of combination of things coming together in terms of countries that are doing, relatively well versus others. I mean, there certainly is a health policy component for countries that were able to quickly and efficiently implement track, test, and trace. I think those are obviously very important systems to have in place, and some European countries have been more successful, like Germany, than other countries. But then again, it's also about how much fiscal stimulus is being provided and, how much do investors buy that stimulus is likely to last. And here, I think, it's really the UK that I would point to as a slightly concerning case where the furlough scheme is likely to end in autumn, even though we don't expect that coronavirus will have gone away by autumn. And so the impact on workers from localized lockdowns, I think, is something that a lot of governments are going to have to start to get to grips with. And that is, a real source of uncertainty for the growth outlook.
So, Stephanie, when we talk about fiscal stimulus, we have to come back to Washington, the U.S. economy right now, as we still are going back and forth about this. What we're exactly going to do for the economy. What do you make of the U.S. economy, and to what extent are markets now starting to pay attention to the election coming up?
So I think you've got to split this out a little bit, I think, into, clearly the weekend was hugely unusual in terms of the fiscal negotiations breaking down and the Trump executive orders coming through. I think we can debate the economic merits of the executive orders, but the political power is likely, to play to parts of Trump's base in particular. And you have to bear in mind, all of this is taking place right before an election. Now, I ultimately think that both sides are incentivized to agree a fiscal package, that maybe you get a couple of weeks of very little negotiation as the kind of political glow of Trump's executive orders start to wear off, and then reality bites and both parties have to come back together and try and get a deal. And I think the incentives are there to build a deal. But if you think, beyond November, we could be looking at a totally different fiscal environment. If Joe Biden gets elected with Democrats in the Senate, which is actually our base case, that actually would say to me, you're looking at a potentially significant difference in the composition of fiscal policy towards much more spending that's financed by, taxation on corporates and on high-income individuals. And I think investors need to get to grips with that quite different composition that they may be facing come January.
Well, normally when governments spend a lot of money, it's good for equities. Do you think it would be in this instance?
Well, it's tricky, right? Because, risk assets don't tend to like increased regulation and they don't tend to like increased corporate tax. And in both cases, I think the Biden administration, particularly with Democrats taking a majority in both the House and the Senate, would be likely to see, upward pressure on corporate tax rates, upward pressure or, greater pressure on things like even the way that regulation is applied to key sectors for the S&P. So think healthcare, financials, energy, tech. Those kinds of sectors are crucial to the index, and they're likely to see, at least markets worrying about greater regulation. The reality of those regulations and how they bite, I think, is much more up for debate. But that kind of push-pull of having, yes, fiscal support in a time when the U.S. economy needs it, but the composition of that fiscal support being less traditionally market-friendly, I think is something investors will have to grapple with. And you might see a lot of kind of movement around how investors are pricing the extent to which it's good or bad to have a Biden presidency.
Okay, thank you so much, Stephanie. It's always a pleasure to have you with us. Stephanie Kelly from Aberdeen Standard Investments. She's the senior political economist there. And now it's time for Bloomberg First Word News. And for that, we go to Mark Crumpton.
2 years after the United States withdrew from that landmark 2015 nuclear deal with Iran, the Trump administration is threatening to reimpose sanctions that were eased under the accord. The UN Security Council could vote as soon as today on a U.S. resolution to make permanent an international ban on arms deals with Iran that's due to expire in October. Russia and China, as permanent members of the Council, have threatened to use their veto power to kill that resolution. Another escalation of trade tensions between the U.S. and China. The Trump administration will order imports from Hong Kong to be labeled Made in China. The actual economic impact may not be large. Most of Hong Kong's shipments to the U.S. are exports from other places. The U.S. is making the change after President Trump ended Hong Kong's special trade status with the United States. The United Nations is sending tens of thousands of tons of wheat flour to Lebanon to try to prevent a food shortage. That's after those explosions last week at Beirut's main port that killed more than 150 people and wounded thousands of others. The blasts also destroyed the city's main grain silo. The UN's humanitarian agency says the first wheat shipment will arrive in the coming days and will supply Lebanese bakeries for a month. People across the Midwestern United States are cleaning up today after some severe weather ripped through the area. A line of storms 160 miles wide cut a path of destruction across Iowa, Illinois, and Indiana Monday. Lightning, hail, and fierce winds tore apart trees and homes. More than 1 million people remain without power. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David?
Thanks so much, Mark. Coming up, former House Majority Leader Eric Cantor is here for his take on the economy, the stimulus, and what it is doing to the C-suite. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Uncertainty may be the theme for 2020 over the virus, over the economy, over national leadership. We welcome now someone who has dealt with the consequences of this uncertainty every day in the business world after holding one of the most senior leadership positions in government. Eric Cantor served as the House Majority Leader and is now Vice Chairman and Managing Director of Moelis and Company. So thanks, Eric, very much for being here. Give us a sense. You deal with CEOs, C-suite all the time, talking about possible deals. How are they reacting given all the uncertainty we're seeing?
Well, Dave, it's good to be with you. Well, I think what we're seeing at Moelis and Company is actually a pent-up demand for quality assets. And if you've got a quality asset, there is a lot of interest on the part of our corporate clients, our private equity clients, and in many cases, those kind of assets are attracting so much attention that some of the potential buyers are looking to pay even pre-COVID prices for those kind of assets. And when you're talking about assets, you're talking about COVID resistant assets. So obviously assets in the healthcare space, the technology space, the business services space. This is where we're seeing now increasing momentum coming forth and a lot more robust dialogue than we had maybe a month or 6 weeks ago.
How is the very loose monetary policy, if I can characterize that, how is that affecting prices?
Well, I think there's no question that having the loose monetary policy, the consequence of that is clearly in lower interest rates, so the cost of borrowing is going to be lower. Access to capital continues to be good. Even the credit markets, when they were ailing in the beginning of this, the Fed stepped in, has announced it'll be the backstop. So for the most part, I think you've got a much more healthy kind of environment in terms of access to capital than people originally would have thought when we entered this pandemic.
Does that drive a CEO, in fact, to have a little bit of an itchy trigger figure because he can get access to an awful lot of capital, or she can?
Well, I mean, I think it depends on the kind of CEO and where the company sits. If it's a large cap company, obviously we've seen the latest figures, and there's been an uptick on the over $10 billion announcements in terms of M&A deals. But you also have the private sponsors end. And as we know, there's been a proliferation of private sponsors over the last decade. And you're now at a point where there's like 9,000 private equity firms out there. And I would say maybe 500, 1,000 of which are several $1 billion apiece of interest to a firm like Moelis. And those firms, if you think, I mean, those private equity firms, they're built to do deals. I mean, they raise money, their investors are expecting them to allocate and invest capital. And so those are the kind of things that these are the elements that were in place pre-pandemic, exist during, and will exist after. So it's that dynamic that is continuing to push, I think, some of this dialogue along.
In order to make an investment make sense, you need to be confident there's going to be demand for the product or service coming up. And that takes us back to the economy, an economy that continues to limp along. It's made some progress back, but I think it's fair to say it's a long way from out of the woods. What do you make of this fight over stimulus right now in Washington? You spent so much time there. You understand these players.
Well, I think, first of all, it is a given that we're not going to see a full return to our economic normalcy until a vaccine arrives. So in the meantime, I think it is incumbent upon the government to address the needs that arise for those who are out of work. I mean, that's first and foremost. And that's why you're seeing a lot of this skirmish take place around the unemployment insurance number. How much is it going to be? I just think what we're going to see a prolonged period of time where these what we call automatic stabilizers like unemployment insurance are going to be in place and are going to be elevated for quite some time. And eventually there will be, in my opinion, a deal done in Washington around a relief package. I think it'll be a lot more targeted than perhaps the CARES Act was. Companies on the whole that will be beneficiaries of the continued support will be companies who have suffered disproportionately under the pandemic. It won't be just all companies. I also think that you can't do without some assistance to state and local governments. Number one, they're a large employer in our economy. And I don't think anybody wants to see this massive number of people just dumped onto the unemployment rolls. And that dislocation is going to have to be managed. And then lastly, it's about school openings. We're not going to see a return to economic strength unless we see the school openings. And that's where the localities, the states are going to need some help, some guidance, some resources to allow that to happen.
So Eric, late yesterday, President Trump came out and said that he was at least seriously considering, as he put it, unilaterally imposing some sort of relief on capital gains tax. Now, we've heard that, particularly from Republicans through the years. He says it will create a lot more jobs. Does that hold true today, particularly when the interest rates are so low?
Well, I mean, I think, first of all, cap gains and taxation has to do with valuations, too. And with the elevated nature of valuations right now, there are a lot of gains to be had. And if an investor believes that he or she can benefit from a lower capital gains rates going forward, I think it does prompt more interest in putting capital at risk. I've always been a believer in a risk-based system of investment in this country. We're the best there is in the world. So I do think it would be additive. Now, the question's always been in Washington about the president or any executive's authority to actually affect the rate. And I believe the way, we haven't seen a lot of details on this, but I believe the way that the White House or President Trump would go about this would be to provide or impose an indexing on the capital gains rates, which would then, again, allow for an investor to avoid the inflation impact of an increase in valuation. So, as you say, with rates or inflation so low, perhaps the impact of a move like that will be more muted. It'll still send a signal, though, that risk-based investors should look positively on a development like that.
And finally, Eric, just more broadly as a matter of governance, does the president coming in, as he did with 4 executive orders last weekend and now talking about possibly indexing capital gains tax, is that conducive to the parties getting together and agreeing on something, or does it actually get in the way of it?
Well, I think, it is Washington, in its typical form. I mean, the two parties are squared off now. We're 80-some days out from the election. And this is going to be one of the most impactful times because of the pandemic, because of where we are politically so divided. This election obviously has huge, huge significance on policy. So in the end, I do think that the move by the Trump administration and by the president will bring parties together at some point. It does signal, however, and I think most people across the country are going to receive the news of the executive orders as being, well, look, at least the president's trying to do something while Congress just seems just embroiled in its fight. And I don't think Nancy Pelosi, Chuck Schumer are going to want to sit at the receiving end of that criticism for long.
Yeah, you know more about it than I do, but usually running against Congress is not a bad strategy. Thanks so much to Eric Cantor, Moelis & Company Vice Chairman and former House Majority Leader. Coming up, a new initiative to create 100,000 new skilled jobs for underserved young people in New York. We talk with Accenture CEO Julie Sweet. This is Balance of Power on Bloomberg Television and Radio. A group of 27 CEOs from the New York area has gone together to form a new thing called the New York CEO Jobs Council and create 100,000 new skilled jobs for underserved New Yorkers. We talked earlier today with the CEO of Accenture, she's Julie Sweet, who's also a co-chair of the venture.
Before the pandemic, we'd actually come together, and this council has been in formation for some time. The pandemic, of course, has put even more pressure on underserved New Yorkers. And also, very importantly, it's changing the whole jobs picture. You hear about things like digital transformation. You're going to have more automation. There's going to be pressure on jobs and that many underserved New Yorkers might access today. And so it's even more important that we help these communities get to stable, well-paying jobs. And what's so unique about this effort is it's both CEO-led, but you have some of the most important industries for the future, like healthcare, financial services, and technology, well represented, which is critical for those kinds of jobs that we need to create.
We've seen a lot, talked a lot about the growing wealth and income inequality in the country, and many people say that goes back to the question of education and skills. There's a difference sometimes between education and skills, because we tend to think of four-year liberal arts college. What are you going to be doing to prepare these young men and women?
It is important to distinguish between skills and education, because one of the things that we found at Accenture, for example, is that many things that we used to require a four-year degree, we now have apprentices with 2 years degree who are very successfully doing that and then moving on to better jobs. We have 700 apprentices at Accenture currently. And so focusing on what are the demands of the job and what are the skills are critical to opening up more opportunities at companies like those represented on the New York CEO Council. But separately from that, what the council's also doing is working together to make sure that we also serve the particular needs of these communities. Many of the individuals that we'll be serving don't come from families where they've had other people who work in the types of companies represented here. And so we're also partnering with not-for-profit organizations in addition to educational institutions like CUNY to make sure that these individuals have the soft skills and the support they need to succeed at these types of companies.
100,000 jobs sounds like an awful lot. It's over 10 years. At the same time, New York is a very big place. It feels almost like a drop in the bucket, an important drop, but a drop in the bucket. Can this really help move the needle, do you think?
Well, first of all, No one has done something of this scale to date. And so while I agree with you, 100,000 jobs isn't going to be the answer to all of the economic opportunity that needs to be created, it's a first step at a really, truly scaled opportunity. And believe me, with the CEOs on this council, we'll be raising our ambition as we begin to deliver on our commitments.
Julie, this sounds like a wonderful thing, almost eleemosynary. Is this charity or is this doing something more profound for New York?
David, this is not charity. This is about opening up the avenues to great talent that's being untapped today. Remember, there are more jobs than people to fill them still in New York City. And so we need greater skills, but also, and we've seen this at Accenture, these communities are filled with great talent who just needs the opportunity. And our own experience with apprentices is that they are innovative. They have a great desire to learn. They're committed to the company. They're committed to their community and their colleagues. They are, in short, right, a profile of the types of employees that companies like Accenture and those involved in the council want for the future.
That was Julie Sweet. She's CEO of Accenture and also co-chair of the New York CEO Jobs Council. Peter Grauer, chairman of Bloomberg LP, parent company of Bloomberg News, serves on that council. Coming up in our second hour of Balance of Power, we're going to be joined by Eli Lake talking about what a Biden policy toward Iran might look like. This is Balance of Power on Bloomberg Television and on radio.